Hello, everyone. Thank you very much for joining us once again today and welcome back. We are discussing today corporate tax return section 3. We have already spoken. We have already conducted two webinars on the corporate tax return guide, and this is our third webinar. These are the previous webinars, corporate tax return guide. If you are going into the corporate tax return guide, these are the sections. Out of this, already we have spoken about section 1 to section 9. Today we are speaking about section 10, section 11, 12, 13, and 14, 15. In our next section, we'll be speaking about the rest of the sections as well. So if you are going into the guide issued by the FTA, how to determine the taxable income, you will find there that the basis is accounting income. This is accounting income. This is the basis. So basis is the accounting income. They have taken this base accounting income. Then they have adjusted unrealized gain and loss exempt income. They have adjusted relief. Then they are asking us to adjust the non-deductible expenditures after this. After there, they are asking to make the adjustment about the reliefs, any other adjustment, then we are arriving at taxable income or tax loss. From the taxable income or tax loss, once we are arriving at the taxable income or tax loss, then we need to make the adjustment about the losses. These losses can be carry forward losses or it can be losses that we are taking from other taxable person. After making this adjustment, then we need to arrive at the tax liability. From the tax liability, we need to adjust the foreign tax credits. Then it will be the net amount that will be payable to the Federal Tax Authority. So what I'm trying to say basically, whenever you are making accounting income as your base, you are mapping the accounting income into the taxable income, then you are mapping the accounting expenditures in your taxable expenditures. Then you have accounting tax sales, tax deductible expenses. Whenever you are deducting these deductible expenses out of the taxable sales, then you are arriving at your taxable income. From the taxable income, you need to make the adjustment of the losses. Once you are adjusting the losses, then you will be arriving at the net taxable income. Then you, based upon that net taxable income, you will be calculating the tax liability. After calculating the tax liability, you will be adjusting the foreign tax credit. Once this foreign tax credit is being adjusted, then you will be arriving at the net tax payable to the FTA or net refund from the FTA. This is the basically follow up the information, or you can say the how the return has been structured. So out of this, the point that we've already discussed, as I mentioned, section 9 we have already discussed. These section 9 other adjustment we have already discussed. We are discussing today section 10. This section is tax liability review and decision. So if I'm asking about the tax liability, before arriving at the tax liability, you need to arrive accounting taxable sales, taxable sales less deductible expenditure. Then you will be arriving at your taxable income. Out of the taxable income, you need to adjust your tax losses. Once you are adjusting your tax losses, you will be arriving at a net taxable income. So this taxable income is basically, what is the taxable income? Taxable income is taxable sales, deductible expenditure. You will be arriving at a taxable income. Then you are making adjustment of the losses. These losses can be your own carry forward losses, or it can be the losses that has been transferred by any other taxable person. All the questions in the returns have been structured based upon this basic understanding that Does the taxable person wanted to claim the losses? Yes or no? If you wanted to claim the losses, then might be these are your own carry forward losses as I mentioned, or might be you are taking the losses from other taxable person. Once you are putting yes, one other schedule will be open. You need to fulfill that schedule. We need to fill the information in that schedule, in that schedule. Once you are filling the information in that schedule, then they will be arriving on the net taxable income. And these all questions like this, it can be, does the taxable person wish to claim tax losses from or surrender tax losses to another taxable entity? There is a possibility if your entity is making losses, might be you are surrendering the taxable losses to another taxable person, because law allows you that you can take the taxable losses from other taxable person and you can transfer your taxable losses to other taxable person as well. So it can be both way arrangement. So this is the reason this question has been asked. Then tax unutilized losses, tax losses claim from other. This is for the group question. So this is very basic thing. What I'm trying to say, once you are arriving at your taxable income, you need to make the adjustment of losses. These losses can be your own carry forward losses, or might be you're taking the losses from other taxable person, or might be you are transferring the losses to another taxable person. These are the questions related to this. We'll be going, these are exactly question as per the guide as well. This is losses schedule that you need to fulfill. Once you are putting yes, then this losses schedule will be open, that you need to fulfill this schedule, fill this schedule. We will be discussing this schedule in our next webinar, because this schedule is part of the tax return guide as well. We'll be discussing in our next webinars. Then the next question is losses claimed from other taxable person, name of the transferring entity, their TRN number, amount of losses that you're taking from other taxable person, losses transferred to another taxable person, the same information to whom these losses are being transferred, their TRN number, how much is the amount that you are transferring to other taxable person. Tax liability and tax credit. Once you are adjusting the losses, as I mentioned, sorry, I'm repeating the same thing again and again. Taxable sales less deductible expenditure, you will be arriving at the taxable income. From the taxable income, you are making adjustment of losses. Once you are making adjustment of losses, you will be arriving at the net taxable income. Then you will be calculating your tax liability up to 375,000, 0%, beyond that 9%. The system will be calculating this automatically. Once you are putting the information, inserting the information, once you are inserting the information into the template or schedule given on the FTA portal, then system will be calculating the tax liability automatically. This tax liability, after this tax liability, you need to make the adjustment of tax credits. While making the adjustment of tax credit, I will go through quickly the basics of tax credit. We'll be discussing, okay, we'll be discussing in the schedule of tax credit. Just wait for it. So we will making adjustment of tax credit. Once you're making adjustment of tax credit, what is tax credit? Might be you have paid any amount of tax out of the UAE. It can be in the form of withholding tax. It can be in the form of corporate tax, but it will not be any sales tax, any VAT, any excise duty, any fine, any penalty. It will be nothing like this. So any amount that you have paid out of the UAE, any amount of tax that you have paid out of the UAE, you have right to take the foreign tax credit in the UAE return. Make sure whenever you are calculating the foreign tax credit, you need to calculate the taxable income related to, sorry, tax liability related to foreign source income. I'm repeating, you need to calculate the tax liability related to the foreign source income. Means foreign source income, you need to map exactly as per the UE law. You need to calculate their taxable income. Based upon this taxable income, you need to calculate the how much is the tax payable on the foreign source income in the UAE as per the UAE tax law, and how much amount of the tax that you've already paid in the jurisdiction out of the UAE. So you will have two amount. One amount will be the tax that you've already paid out of the UAE in the foreign jurisdiction. Second amount will be tax liability on the foreign source income as per the UAE corporate tax law. So you will have these two amounts, and law says lower of this you have a right to calculate the foreign tax credit. But if you have a losses in the current period, you will not have a right to take the advantage for the foreign tax credit, and this foreign tax credit cannot be carried forward, it cannot be carried back. So I'm repeating, foreign tax credit, you will have two amounts: the tax paid out of the UAE as per their laws and regulation, as per the respective jurisdictions laws and regulation, tax paid out of the UAE, and tax payable on the foreign source income as per the UAE corporate tax law. Two values you will have. You need to compare both of these values. Lower of this, it will be allowed to you as a foreign tax credit. And it should not be, as I mentioned, whenever you are calculating as per the local laws, as per the UAE corporate tax law, tax rate applicable will be 9%. So maximum, lower of this is maximum you can take 9%. So if you have a current period losses, you will not be allowed any foreign tax credit advantage. Whatever is the tax paid out of the UAE, it will not be carried forward, it will not be carried back. So all these questions related to the foreign tax credit that you have paid out of the UAE. Now you can go through the questions of the return, it will give you better clarity. Does the taxable person wish to use any foreign tax credit? Yes or no? This is all up to you. If you are putting yes, the schedule will be open. You will have to fill the information in the schedule. If you are putting no, the return will allow us to proceed further. Assuming you are putting yes. Once you are putting yes, how much is the foreign tax credit? Then which country? How much is the taxable income attributable to that country? How much is the tax liability? How much you have the tax paid? How much is the tax as per the UAE jurisdiction? Then the system will compare automatically. System will allow you the lower of these two amounts. And again, as I mentioned, if you have losses, then system will not give you any foreign tax credit. This is about the foreign tax credit. These are estimated provisional figure in the return. Might be you already created the provision. If you already created the provision in the return, you need to adjust and put that number as well. So these documents you need to attach. You can go through the documents. I'm not going into the detail because we have so many other things to discuss. These are very basic information. We have already spoken so many times about this. You need to review it. You need to declare it. Then you need to put your name. A taxable income system is calculating and you need net amount of tax it will go. Now I'm going through the guide quickly. This is the foreign tax credit. I believe you will be able to see this. So these are tax losses that we have already discussed. If you are going through the question, the other taxable person brought forward losses, taxable claim tax losses, surrender means you have own losses, might be you are transferring surrendering losses, tax losses utilizing the current period, because you can carry forward the losses for unlimited period of time, but it should be 20, I think it should be 75% of your taxable income as far as I can remember. It can be adjusted. Remaining will be carried forward for unlimited period of time. Tax losses claim. This is for the group. Might be any member of the group has tax losses, and that member is surrendering the losses, receiving the losses, transferring the losses. Then this is regarding the tax group losses, tax group and brought forward losses. So if you are going through in detail about this, whatever we are discussed, some basic questions are there. Nothing other than this. Other group entities, tax calculation and tax credits. Taxable income after tax loss adjustment. This is what we discussed. Taxable income losses will be adjusted. You will be arriving at a net taxable income. Corporate tax liability system will be calculating 0% up to 375,000. Beyond that, 9%. Once you have this liability, then you need to adjust the foreign tax credit. These are the tax credit sections. Corporate tax payable. Provision thing we have discussed already. Might be you already created a provision in your return. You need to adjust it, and system will adjust it automatically to arrive at the final liability. These are the review and declaration. What is the date? Confirm who the return is being prepared, who is submitting, name, person, all the very basic information, not going into detail. Coming back to the free zone schedule. Now we have discussed return is final, by the way. Return is final. Now these are the schedules. Wherever you are putting yes, sometimes system is asking and asking to fill the information in the respective schedule. And you need to fill the information in the respective schedule. This schedule is for the free zone person schedule. And before going to the free zone person schedule, I will ask you, I will request you, let's go together summary of the free zone person. Then we would in a better position to discuss these questions. So what is the free zone person? Free zone person is qualifying free zone person. It can be only juridical person. Other than this, no one can be the qualifying free zone person. These are the basic conditions for becoming a qualifying free zone person. By default, you will be a qualifying free zone person. Just keep in mind. These are the 6 conditions that you need to maintain to keep yourself as a qualifying free zone person. These conditions should be met throughout the period of time. These are the relief the qualifying for free zone person cannot get it. Qualifying free zone person, they need to maintain the adequate substance in the free zone, but if they're in the distribution business, they need to maintain the adequate substance into the designated zones. This we have already discussed. This is the qualifying free zone person. Income, qualifying income derived from other free zone person, where the other free zone person is the beneficial recipient. Revenue derived from the non-free zone person from the qualifying activities except excluded activities. Qualifying intellectual property revenue derived being the qualifying intellectual property. One stream of the commercial property we have already discussed, that is qualifying income as well. So any other, if the de minimis criteria is being met, where the other non-qualifying less than 5% or 5 million, whichever is lower, that will be considered qualifying. Just keep in mind, because we need to go through the questions of the guide. We have discussed this. If the qualifying prison person okay, if the qualifying free zone person is making transaction with other free zone person, which is the beneficial recipient, qualifying income. If the qualifying free zone person making anything with the non-free zone person qualifying activity, it will be considered as qualifying income, assuming these are the not excluded activities. This is qualifying income of the qualifying free zone from the qualifying intellectual property. This is based upon the formula, and based upon this, some portion of the qualifying intellectual property can be qualifying income. Rest all it will be subject to tax at straightforward 9%. One stream of the commercial property is a qualifying income. Rest of the all income related to that, it can be non-qualifying income. Income that is being generated from the domestic PE, foreign PE, straightforward subject to tax at 9%. So basically, for income of the qualifying free zone person will be straightforward subject to tax at 9%. Remaining income will be qualifying income. It will be zero rated. There are no concept of 309% up to 375,000. Just keeping this in mind as well. So this is the basic criteria for the de minimis criteria. 5% of the total revenue of 5 million, whichever is lower. So this slide is very important, very, very important. Whenever you are addressing the questions given in the UAE corporate tax return, you need to have a thorough understanding about the classification of revenue. So qualifying free zone person, the revenue can be classified into exempt income or it can be a taxable income. Exempt income, we have already discussed so many times. What is exempt income? It can be dividend or it can be income being derived from the participation exemption. We'll discuss this. So taxable income, these 4 incomes of the qualifying free zone persons are straightforward subject to tax at 9%. Domestic PE, foreign PE, immovable property, except the one stream. Income from the intellectual property, except the qualifying income of the qualifying intellectual property. Other than this, these 4 income are straightforward subject to tax at 9%. So initially we split the income into exempt income, taxable income. Out of the taxable income, some income has gone straightforward subject to tax at 9%. Remaining is the other income. Now we need to look into this. This other income is my qualifying income or non-qualifying income. And non-qualifying income should not be more than 5% of this total income. This total income. This. Whenever we are considering total income, we should not consider this. We should not consider this. We need to consider only this revenue. So non-qualifying revenue means income from excluded activities, free zone person who is not subject to beneficial recipient, non-qualifying activity from the non-free zone person. This is my non-qualifying revenue. This is my qualifying revenue. We have already discussed income that is being generated from the other free zone person who is the beneficial recipient, income that is being generated from the non-free zone person from the qualifying activities, one stream of the commercial property, qualifying of the qualifying intellectual property. For income will be qualifying income. These income will be non-qualifying income. This non-qualifying income should not be more than 5% of this total revenue. I believe everybody is clear. Then we'll be going to the question directly. These are the excluded activities. I think we've already discussed so many times. You can go through this. These are the qualifying income. I'm asking whenever the qualifying free zone person is generating any income from the non-free zone person from the qualifying activities, it will be zero rated as well. So these are the qualifying activities. Calculating taxable income, your exempt income of qualifying free zone person, exempt income, taxable income 9%, 0%. This is the four income that we discussed earlier. This is the qualifying, non-qualifying, where this is non-qualifying income, it should be less than 5% of the total income. We have discussed this. If there are any expenses of the qualifying free zone person, it should be allocated in between the exempt income, standard rated revenue, and qualifying revenue. Very simple, but where there are direct expenses will be allocated directly. Where these are the common expenditure, we need to identify allocation keys. Based upon the allocation keys, common expenses needs to be allocated in between the exempt income, standard rated revenue, and non-qualifying revenue as well. So these are the basics. Now let's go through the questions of the guide. Let's go together. These are the questions of the guide in the return. Tax revenue as per the financial statement, straightforward, you can take it. Does the free zone person have a domestic or foreign PE? Why they are asking? Because this income is straightforward, subject to tax at 9%. That's why they are asking. Total revenue attributable to domestic and foreign PE, basic thing. Does this for qualify free zone person derive revenue from transaction with non-free zone person? Why they are asking in respect of commercial property? As I mentioned earlier, if this is a commercial property, one stream from the commercial property, the qualifying income, rest all income from the commercial property or immoral property, straightforward, subject to tax at 9%. So they are asking question, the system of the FTA wanted to establish by itself, does this income is a qualified income or not? This is the reason they are asking question. What are those questions that were discussed earlier? Property should be within the free zone. It should be a commercial property. Property is not being used for residential living purpose. Transaction is being made with other free zone person. I think these are the conditions. Based upon this, if you are putting all yes, system will automatically say, okay, this is the qualifying income. If you're not addressing the question properly, system will classify the information. The system will classify the income into a different category. So this question is, does the free zone person deriving revenue from transaction with non-free zone person in respect of commercial property? You could address this question. Total revenue derived from transaction with the free zone person in respect of commercial property. This is the same thing as I mentioned earlier. Does the free zone income from the immovable property, straightforward, subject to tax at 9%? If all those criteria is not being met, this is the reason they are asking this question. Total revenue from the immovable property in free zone, that is the commercial property, you can address this. Does the free zone person derive revenue from the ownership of intellectual property? Intellectual property, there are two types of intellectual property, qualifying and non-qualifying. We need to look into the criteria. One is the qualifying intellectual property. Some income of the qualifying intellectual property will be qualifying income based upon the formula that we already discussed. Remaining will be non-qualifying income. Now, they wanted to ask the question about they wanted system, wanted to establish how much is the qualifying income, how much is the non-qualifying income. Non-qualifying income will be straightforward, subject to tax at 9%. Qualifying income, subject to tax at 0%. So this is the question related to the intellectual property. Does the free zone person derive revenue from the ownership or exploitation of intellectual property? First question. The total revenue derived from the ownership and exploitation of intellectual property that is not considered qualifying income. That is not considered qualifying income. You need to apply the formula. You need to calculate how much is the qualifying income, non-qualifying income. Then you need to address how much is the non-qualifying income. Total revenue from the de minimis requirement. De minimis revenue we already discussed. What is the portion? Which income will fall under the de minimis? We have already discussed. Revenue derived from excluded activities. How many excluded activities are there? I think 5 or 6. How much revenue is being derived from there? Revenue derived from the excluded activities will be following non-qualifying revenue. It will be considered for the de minimis purposes as well. We have already discussed on the slide. Revenue derived from activities that are not qualifying activities, where the other party is from a non-free zone person. Non-free zone person, revenue being generated from the non-qualifying activities from non-free zone person, it will be classified as a non-qualifying revenue. Revenue derived from transactions with free zone person that are not the beneficial recipient, none. This will be considered as non-qualifying revenue. This is the total non-qualifying revenue. I believe everybody is clear. If you are going back to the slide again, they are asking all the related questions as we discussed. Again, I can open the slide for you. They are all question based upon this box. You can look into this. Means excluded activities, free zone person who is not the beneficial recipient, non-qualifying revenue. So these are my total non-qualifying revenue. So they are asking this question about this, the total non-qualifying revenue. Is the de minimis requirement met? While calculating the de minimis criteria, I'm repeating, this revenue, non-qualifying revenue divided by this revenue. While calculating, this should not be included. This revenue should not be included. This revenue should not be included as well. So this is the question they are asking. Is the de minimis requirement met? Yes or no? Now qualifying revenue. We have already discussed the categories of the qualifying revenue. Now all these questions about will be related to the qualifying revenue. What is the qualifying revenue? Revenue that is being generated from the other free zone person who is the beneficial recipient. Revenue that is being generated non-free zone person from the qualifying activities. Qualifying income of the qualifying intellectual property, one stream of the commercial property, and de minimis criteria, non-qualifying income where the de minimis criteria is being met. There are 5 categories of qualifying income. So all these questions, I'm repeating, all these questions will be related to this box only. Now revenue derived from the free zone person except from income derived from the excluded activities, except for excluded activities. Because excluded activity, even you are generating the revenue from the other free zone person, but this is from excluded activities, it will be falling under the non-qualifying revenue. So this is the first question they are asking. I am receiving questions. We'll be looking into these questions by the end of the webinar. So qualifying revenue, excluded activity, it will be straightforward. Non-qualifying revenue. Now revenue derived from non-free qualifying activities in revenue derived from non-free zone person in respect of qualifying activities. Revenue derived from non-free zone persons in respect of qualifying activity. It should be a qualifying activity. Yes, it should be qualified, that we already discussed. Revenue that is being generated from the other free zone person except the person who is not the beneficial recipient, and these activities are not excluded activities, is a qualifying income. Revenue that is being generated from the non-free zone person from the qualifying activities, it will be falling under the qualifying income. This question is related to that. So unless and until you will not have a basic and thorough understanding of the law, you will not be able to address these questions. You must have a thorough understanding of the law. Qualifying activities undertaking, which qualifying activity you are undertaking. Revenue derived from the ownership and exploitation of qualifying intellectual property. And now implies, why they are asking about the implies? Because you need to maintain the adequate substance in the free zone. And if you are in the distribution business, you need to maintain the adequate substance in the designated zone. And one of the condition for the adequate substance, you need to maintain the, you need to hire the employees as well. Others are core income generating activity. SIGA. SIGA should be in the free zone, or it has been outsourced to the free zone person in your supervision. Adequate expenses, adequate employees, adequate assets. So this is questions. Now they are asking these questions to establish, are you maintaining are you maintaining the adequate substance in the free zone or not? These questions related to this exactly to address this area. All the employees located in the free zone. All or any employees located in the free zone. Yes or no? If you are putting no, straightforward, you will be going out of the, you are not meeting the qualifying free zone person criteria. You will be going out of this criteria for the current period and the next 4 years. So you need to maintain the adequate substance. You need to hire the employees over there. Are your employees located in the free zone? Total number of every time employees, total every number of full-time employees, total every number of full-time employees located in the free zone. When they are asking average employees at the beginning of the year, employees at the end of the year divided by 2, it has been given here. You can go through this. Total operating expenditure, total capital expenditures. Why? Because you need to maintain, as I mentioned, adequate assets, adequate employees, and adequate assets, employees, and expenses. This is the reason they are asking this question. Enter the amount appropriate. Have any of the core income generating activity been outsourced to any outsourced provider? Why they are asking? Because if you are a qualifying free zone person, you need to maintain the adequate substance, and you need to maintain the adequate substance by being a qualifying free zone person. And adequate substance means you need to perform the core income generating activity, SIGA in the free zone. If you are not performing the SIGA in the free zone, then you need to outsource the SIGA to any other free zone person. Once you are outsourcing to other free zone person, you need to supervise as well. One option is there, whenever you are performing, you are in the qualifying intellectual property business, you can outsource the core income generating activities to any other person in the UAE or to any other person out of the UAE as well, but the person out of the UAE should not be your related party. So this where you can outsource the SIGA out of the free zone in case of qualifying intellectual property business. Otherwise, SIGA needs to be outsourced within the free zone. It should be under your supervision. Even you are outsourcing the SIGA core income generating activities out of the UAE to your related party in the UAE or to any other person out of the UAE which is not your related party, it must be under your supervision. How will you supervise it? You need to maintain the proper SOPs, what they need to do, how they need to do, proper check and balance. You need to have proper documentation. These all questions are related to this. So have any of the core income generating activities been outsourced to any other outsource provider? Yes or no? Number of outsource provider, name, address. Why address? They wanted to establish are you in the free zone or are you out of the free zone? Their TRN number, total expenditure out of the free. Another condition is the person to whom you are outsourcing the core income generating activity, they need to they need to they need to have the proper expenses, proper assets, proper employees. It will be their verification as well. You cannot outsource to any other person who doesn't have the assets, who doesn't have the employees, who doesn't have the expenses in the free zone or out of the free zone in case of qualifying intellectual property business. This is the reason they are asking this question. Total expenditure incurred on the outsourcing provider during the tax period. Total average number of full-time employees provided by the outsourcing provider. Confirmation, the adequate supervision. This is what I was asking. Now the free zone confirmation, adequate amount of assets. Assets they are asking, number of qualified. Guys, you can go through this very honestly. I have already told you this is related to how they are maintaining the adequate substance, these adequate expenses, adequate assets, adequate employees. And if you are outsourcing, the person to whom you are outsourcing the business, the person must be in the free zone. And this should be under the proper supervision. If you are outsourcing to someone else out of the free zone, in case of qualifying intellectual property business, then all those conditions needs to be met, and these all questions you need to be addressed very properly, and you need to be very careful while addressing these questions. If you are addressing the wrong questions, might be it will The system will calculate your tax liability wrongly, not the proper tax liability. So transfer private and because transfer pricing, this is one of the conditions of the becoming a qualifying free zone person. The qualifying free zone person must be adherent to the transfer pricing rules and regulations. So this is one of the conditions. This is one of the conditions they need to maintain the audited financial statement. Additional information, detail of EBITDA, salaries and wages attributable to each emirate. These you can provide additional information as well. Free zone person from intellectual property schedule. Go through intellectual property. I've already told you the basis. If you're going through the questions, these questions are not unusual questions. These are very straightforward questions if you have understanding of the law. So does the qualifying description of the qualifying intellectual property, overall income derived from the qualifying intellectual property, overall expenditure, qualifying expenditures, uplift expenditure, you can go maximum 30%, 1.3 of the total expenditure. Sorry, of the 1.3 of I think this is of the total expenditures. You can uplift it. Income excess of qualifying income. Go through this. The very basic thing you can go. So basically, we have concluded qualifying free zone person. This is just based upon the basic understanding I will discuss earlier. If you have any specific questions, I'll be happy to address the question. You can drop me an email. Dividend schedule. For the dividend, let's go back to the basics once again. The basics for the dividends are, what are the basics for the dividend? These is what we have discussed already. If you are getting a dividend from the resident juridical person, it will be straightforward exempt without any conditions. And if you are getting a dividend from the any person who is not a resident juridical person, it will be exempt based upon certain conditions. These conditions are investment in the equity up to minimum 4 million or 5% of their equity capital, minimum for 12 months. They held for 12 months, they have intention to hold it for 12 months. Then where you are making the investment, their assets are not being invested into a holding company more than 50%. These are some conditions over there. If these conditions are being met, then your dividend from the participation exemption will be exempt as well. But here we are not discussing the dividend that we are receiving from the participation exemption. Here we are discussing the dividend that you are getting from the resident juridical person. So what are the questions they can ask? What is the name of the resident juridical person? What is the TRN? What is the address? Now, after discussing this basic, let's go back to the question given in the return schedule. Company name, from here you are getting the dividend. This company will be resident juridical person. TRN, profit distribution received. These are the basic question. Objective is basically, if you are getting the dividend from the resident juridical persons, straightforward exempt, they are getting the basic information from of that resident juridical person. How much you have received a dividend, how much dividend you have received from this resident juridical person. Foreign PE, we already discussed PE. Permanent establishment, might be you have a foreign PE as well. This foreign PE like foreign branches. If you have a foreign PE, Article 24. Yes, Article 24 of the law says, if you wanted to opt this, that the income and related expenses of the foreign PE, you will not consider this for your taxable computation. And if you are opting this will be applicable on the all foreign PEs. You cannot pick and choose. Furthermore, they said if you wanted to opt this, there are some certain conditions, like these conditions that the foreign PE is subject to minimum, subject to 9% tax. If these conditions are being met, you can opt it. If these conditions are not being met, you cannot opt it. Now, this thing, another very important thing is for the foreign PE. If you have a foreign PE, for the foreign PE, assuming you have the losses, and losses, assuming in the past year you have adjusted the losses of the foreign PE while calculating your taxable income. Now, in the first year you have adjusted the losses, and second year you wanted to claim the exemption that you will not be considering the income and expenses of the foreign PE. Law says no, you can't do this. Unless and until you have already adjusted the losses to calculate your taxable income, unless and until those losses will be offsetted, adjusted, then till that time you will not be able to claim the foreign PE exemption. I am repeating, if you have already adjusted the losses, just after the adjusting the losses, you cannot claim the foreign PE exemption unless and until those losses has been utilized in the future, then you will be able to claim the foreign PE exemption. So a few things are there. First is foreign PE. Foreign PE means foreign PE, it can be two types, that is meeting the criteria, foreign PE that is not meeting the criteria. If the foreign PE is not meeting the criteria, you cannot claim the exemption. Straightforward, their income will be included in your taxable income, it will be subject to tax. And the foreign PE that is meeting the criteria and you can claim the exemption, it can be two categories, meeting the criteria, yes, or and yes, if this is meeting the criteria, then you have claimed the exemption, you have not claimed the exemption. If you have not claimed the exemption, it will be included in your taxable income straightforward. If you wanted to claim the exemption, now two possibilities further. Does the foreign PE has already adjusted any losses while calculating your taxable income? Unless and until those losses will be utilized, you will not be able to claim the foreign PE exemption. All these questions basically based upon this understanding. Now you go and go to this is prior period. Why they are asking prior period questions? Because there is a possibility that might be you have already adjusted the losses and you are now claiming the exemption. As I mentioned, till the losses will be utilized, you will not be able to claim the exemption foreign PE. They're asking. They're asking which tax period, but this will not be, this section will not be applicable for your first return. Which tax period? Taxable income attributable to the foreign PE. Tax loss attributable to the foreign PE. Was a foreign PE election made in respect of tax period? Election made or not? Does tax loss is attributable to foreign PE which has been utilized against taxable income? Tax loss is attributable to the foreign PE which has been offset against subsequent taxable income. Carry forward losses of the foreign PE. So the objective of the question I have already told you why they are asking. They wanted to make sure that you can have you are right to claim the foreign PE exemption, but you've already adjusted the losses, offset the utilize the losses unless and until these losses are being offset, you will not be able to claim the foreign PE exemption. And there should be a criteria that eligible and ineligible PE as well. So it should be here because the PE can be ineligible as well. Foreign PE. Okay, let's move forward. Might we will find it. So eligible, sorry, yeah, this is eligible foreign PE. This word in itself very important. Are you eligible foreign PE? As I mentioned, two category: eligible, ineligible. If this is eligible, why it is ineligible? Where you are not meeting the condition. Income will be straightforward. Eligible, then you need to include you wanted to opt or not opt. If opted, have you already adjusted the losses or not? This is eligible tax period, taxable income, foreign PE. These the same questions. You can go through these guys. Tax credit, tax credit. Can we go back to the basics of tax credit? Then we'll. I think we have already spoken a lot about the tax credit. We'll speak again. Let me go through these basics. These basics of tax credit. Foreign tax credit is calculated the lesser of the actual foreign tax paid on the foreign outsourced income and the UE corporate tax payable on that income. I think I have spoken about this in the very beginning of this webinar. FTC, foreign tax credit available for the foreign withholding tax as well. A lot of people are asking, withholding tax is not subject to foreign tax credit. No, you have a right to take the foreign tax credit on the withholding tax as well. Taxes like excise, VAT, property tax, custom duty, estate tax, inheritance tax, stamp duty, all these taxes, you cannot take the foreign tax credit because the nature of these taxes is not corporate tax. FT is available taxes like having a nature only for the corporate tax. This is the reason you cannot take the foreign tax credit on these taxes. Fines and penalty, you don't have any right to take the foreign tax credit because by nature, by default, these are not the corporate taxes. Foreign tax paid means amount remitted or committed to pay. You already paid to the respective jurisdiction or you have already committed to pay. But if anything is contingent based, then contingency will not be considered that you have already paid, it will be paid. Suppose your litigation is going on with the respective jurisdiction, might be your tax liability will arise, might be your tax liability will not arise. So if there is any contingency, this contingency will not be considered while calculating your foreign tax paid or payable or committed to pay to the respective tax authority. Proof of payment, they can ask. Paid means committed, remitted to pay. Contingent will not be considered. These foreign tax can change as well. If this is going foreign tax decreased or refunded, then the amount is greater than 10,000 pass VD, less than 10,000 adjust in the current period return or coming period return. Where the tax amount increases or paid more, pass VD. This is basic or already discussed about the foreign tax credit. Cannot exceed the amount of UAE corporate tax due on the foreign source income that we've already spoken. FTC is lower that we have already said. How will you calculate this? Is weighted average base. Total tax divided by foreign source income divided by total income. Multiple sources cannot be offset. There is a one country here, country A, country B, country 3. Each will be calculated separately. You cannot offset this each other and assess this. No, each country, it will be calculated separately. Foreign tax credit is not available in small business relief. Natural person turnover less than 1 million, qualifying for region person overall tax loss during the period. So these are the basics. Now, if you are going through the guide questions, these questions will be exactly based upon this understanding. Country from which jurisdiction you are getting the foreign tax credit or you are paying there the taxes. Taxable income attributable to that country. Tax liability in the how much tax you have paid in that jurisdiction or committed to pay. Confirmation you have evidence of tax liability in the foreign jurisdiction. Already they can ask the evidence as well. Nature of the tax credit, withholding tax, normal corporate tax. What is the nature of the tax credit that you want to take? As I mentioned, you cannot take few inheritance tax, VAT, property tax, fines, penalties. You cannot take foreign tax credit. This is the reason they're asking what is the nature of the taxes that you have paid out of the UAE in the respective jurisdiction. UAE corporate tax due on the relevant income. How much is the tax due? As I discussed earlier, tax paid, tax due as per the UAE corporate tax law. Lower of this you can calculate. Tax credit system will calculate automatically lesser of the amount of corporate tax due and paid in the foreign jurisdiction. The same criteria will be applicable for the tax group as well. If any member of the group is taking the foreign tax credit, we need to provide the information. So, section 16. Section 16 is there, and yeah. 16, related party, tax losses, participation exemption, trust capping rules, tax relief. I think we need to take two more webinars. Important thing I wanted to announce here. Today we have launched calls.com. Calls.com stand for Crest Cooper Online Learning School. This is a UK based school, and why we have launched it, basically we are planning to provide education through the system. I just wanted to give you a demo. I will take your just 1 minute, not more than this. Based upon this, I will be speaking about this. Then we are planning to cut our webinars that we're going to do on weekly basis, and we'll be speaking through. This is calls.com. If you are going on the website, calls.com. On this calls.com, we are offering here, these are the basically initially we are offering the corporate tax trainings for the training for the corporate tax. This will be 40 hours training, and then we are discussing about the IFRS training and this internal auditing standard training. This corporate tax, it will be 14 classes in 40 hours, and it can be 14 classes 40 hours, 12 classes 40 hours initially. If you wanted to enroll, you will be landing on the learning. This is our uh, learning management system. This is cases.com, Crest Cooper e-learning system. So this is our page of our school that we are registered. This is a school only that is providing the training. This is the mode of teaching through which we will be providing the training, learning management system. If you're going on this page, you can check the detail of the, like, you wanted to check the timetable. This is a timetable. Class time span will be 1 month and 17 days. It will be 43 hours training. 3 hours I kept provisional training. Might be we are missing someday. Initially, it will be 40 hours training. 3 hours are the provisional training. Price is $299 for the 40 hours. This is a time zone. That class will be started 5:30 p.m. to end time 8:30. Duration will be 3 hour. Time zone Asia, Dubai. This is the topic. So if you want to know about the profile of the trainer, you can go to the profile of the trainer as well. You can find it on the platform. Here you can find the profile of the trainer as well. These all are very experienced trainers like Mia Farhan, like Tausif Ahmed, like by myself. So I will be taking care of the corporate tax trainings. Mia Farhan will be taking care of the IFRS. And the good thing is, I just wanted to give you explain more. Once you are adding it in your cart, you are paying it. Then on your portal, you will have the list of all classes, and we will be teaching through this system. We will not be required to go to any other platform for teaching. We'll be using this learning management system that were developed in-house. We'll be teaching through the system. It will be interactive session. It will be live session, like usually we are coordinating with on the Zoom. We'll be coordinating on the cases.com. You can ask the question. We'll be seeing each other. There are a lot of good things, and we have a policy that after every important topic, we will have polls, quizzes, we will have polls, then question and answer. So we will wanted to make sure that you have a better understanding of the knowledge that we're delivering it to you. And by the end of the training, calls.com will be issuing the training certificate as well. So this is, I will request you to share in your circle, and after the following two webinars or weekly webinars, we are going to cut down the weekly webinars, and we are going to take the training to the next level. We wanted to make sure that people are getting the certificate. The fees that we are charging, this is a very nominal fee for the 40 classes. But wanted to make sure that the people are getting a proper knowledge. They have the certificate as well. They can enjoy and they can get the grab good jobs in the market based upon their understanding about the corporate tax, IFRS, internal auditing standards. At the end, I will say that we are looking for a trainers, not only for, like, we're looking for trainer for the VAT, looking trainer for the excise duty, management trainings, management courses, like training for the HR trainers. So if any of you or any of you person in your circle, they are interested to provide the training, ask them to contact us. We'll be listing them on our website and we will be marketing them. Then we will be taking care of the next training as well. So appreciate it. If you have any questions specifically, you are most welcome. I have 3 questions here. Is the tax return from available in Excel to make draft? Though this is not available in the Excel format as per my understanding, you need to go onto the FTA portal. Whatever you wanted to do, you just know you need to address and put the numbers. And wherever you are putting, yes, most of the cases schedule will be open. You need to fulfill the schedule on the online, and the amount will be populated automatically on the return template. Kayum is asking only 50% expenses incurred in the tax period for the purpose of entertaining. This is deductible taxable from it in the income. Entertainment expenses only 50% allowed, 50% not allowed. You need to make the adjust of your taxable income accordingly. One more question. Employee you can claim. Sorry, guys. Employee you can claim 100%. Other than employees, you can claim 50%. So this is over from my side. And if you have any further, one more questions is there. Your kind opinion is required for the treatment of owner salaries, partner salaries under the UAE corporate tax. Considering a reasonable market competitive salary, arm length transaction, monthly salaries are being rounded through the company's account for. Sole establishment salaries are not allowed because the law says if you are taking the salary from your one pocket and keeping in your other pocket, sole establishment salaries are not allowed. Natural person salaries are not allowed. Juridical person salaries are allowed, and law says that the market value. What is the market value? You need to go and perform the transfer pricing benchmarking studies. Might be FTA will bring. Initially, I was thinking FTA will bring something salary slab industry. Up to that salary you can claim. Beyond that, you need to perform the benchmarking. I think they have given some slabs as well in the. We have already discussed in the connected person portion of the corporate tax return. I think 500 for the 500,000 is for the connected person and 4 million. I think this is for the related parties. If the amount is up to 4 million or 500,000, that is fine. Beyond that, you need to perform the benchmarking study. There is no other way for the time being. Any other questions? See above and advise for entertainment related to employees, then why we need to add in 50%? What is the required for transfer pricing study? Transfer pricing study, very complicated area, not easy to discuss here. We need to take the database, benchmarking, put all information. This is a huge and very expensive database. Just drop me an email. It will be player supporting you. Okay, guys, as I mentioned, we will have a further two more sessions. Then we'll be concluding. And for the calls.com, looking forward to your support, please. Thank you very much and have a lovely evening. Thank you. Bye bye.